Hello and welcome to Wall Street Vision. On this show, we explore the thinking of the best investors and we examine lessons from the stock market. I'm your host, Vlad Dolgochev. This show is for informational purposes only and is not investment advice. Check out the show notes for the full disclaimer. What's up, Vision Nation? In this week's episode, we're going to cover the story of how Mohnish Pabrai invested in a company called Frontline. Mohnish is a top investor with a great track record. He's the real deal, and I've talked about him on this podcast before. The story I'm going to tell you happened years ago, but I think it's useful to go over it because it illustrates how Mohnish thought of this investment. In this episode, we'll cover how Mohnish used a mental model to figure out that this was a good opportunity. We'll discuss the importance of a circle of competence, and we'll talk about how in investing, information you learn is cumulative, which means stuff you learn about in one industry can apply to other industries as well. Alright, let's dive right into the story. At the time, Frontline was one of the world's biggest oil tanker shipping companies. They owned a fleet of ships that they rented out to people that needed to transport oil all over the world. When it comes to oil tankers, there's different categories of these ships. One category of ship is called a VLCC. A VLCC is a really huge ship that carries a lot of oil on it. VLCC really stands for Very Large Crude Carrier. And I just want to say, how creative is that name? Shipbuilding companies must have a team of marketing executives working to come up with names like that. At the time Mohnish was doing his research, there were around 400 or so of these VLCC ships around the world. Mohnish figured that shipping is a simple enough business. It's not too complicated. These types of ships are used to transport oil from an oil producer to a country that needs oil. It's not like analyzing cryptocurrencies or predicting how a brand new business model is going to perform. The essence of it was that Frontline had this fleet of ships, and they charged their customers for shipping oil around the world. Of course, when you're thinking about investments, you always want to think about potential disruptors. And in this case, one potential disruptor for them are the green energy alternatives that were coming up on the market. But you've got to remember that it would take time for green energy to ramp up and take market share away from oil, so it's a business model that's not going to get disrupted overnight. Mohnish did something really interesting when analyzing this potential investment. He used a mental model from real estate and applied it here. A mental model is a simplified explanation of how something works. In commercial real estate, like tall office towers that are 30 to 50 stories high, usually those office towers take around 4 to 6 years to get built. In real estate, when most of the office space is occupied and rents are increasing, a lot of these large projects to build huge towers get started. Real estate investors look at the current rents that are really high, and they're probably sitting around a big oak desk in their boardroom, and they go, "Wow, there's so much money to be made here. We've got to get a big office tower built as soon as possible." I'm picturing them sitting around saying this in between puffs of their cigars. That leads to the sort of group behavior where lots of real estate investors see these amazing projections of all the money that they're going to be making, and they all want a piece of the pie. So all of these towers get started at the same time, and that means that they're also going to get finished around the same time as well. Which means that they're going to go from having mostly occupied offices with excess demand to a market with lots of available office space. And that leads to booms and busts in commercial real estate. I just want to mention that this doesn't really happen in industrial real estate or commercial warehouse spaces because construction can be finished much quicker in about 12 to 18 months. But these booms and busts do tend to happen when you're building these huge 50-story office towers that take longer to finish. The other point is that if you're building a 50-story tower, it doesn't matter what happens in the market. That tower is going to get finished. There's no stopping that project once the foundation is poured and they've put in a few ground floors already. Going back to the oil shipping industry, there's a similar sort of dynamic happening. There's only a handful of shipyards in the world that build these big ships that carry the crude oil around the world. So if you want a new ship, you go to one of those shipyards, put down a deposit, and in 3+ years, they deliver you the ship. And if there's lots of orders in front of you in the queue, it could take longer than 3 years. This is similar to the real estate example where you might have a situation where demand for the ships is high because oil prices have gone up, but you can't just increase the number of ships overnight. It takes years to build them, which means that as demand for ships goes up, the daily shipping rates would go up as well. Mohnish noticed that shipping rates for these large ships had huge fluctuations. They would go as low as $5,000 per day and up to $250,000 per day. $250,000 per day is not bad for a day's work. In commercial real estate, this sort of thing doesn't happen. You don't have 50-to-1 changes in rates, even when you're looking at decades of price fluctuations. So the shipping business is on steroids compared to the office tower business. The booms and busts are even more exaggerated. Mohnish did his homework and he really understood the dynamics of how daily rates for shipping were calculated. And he also understood that you couldn't instantly increase the fleet of the ships if demand for them increased all of a sudden. Frontline was the shipping company Mohnish looked at. They were the largest operator of these big ships, and they had about 80 ships of the total global supply of about 400 or so. And one key thing is that their whole fleet was not locked into long-term guaranteed contracts. Let's get into a quick description of what that means. There's two ways to run your fleet of ships. One is to have lengthy guaranteed contracts, and the other is to have them get charged per voyage. A guaranteed contract looks like this. There's an oil producer, and they can either lock in a ship at $20,000 per day for the next 2 years. So no matter if they're using the ship or not, the shipping company is getting paid that $20,000 per day over a span of 2 years. Another way to do it is to rent out the ship per voyage. So an example of that is, let's say there's a company that needs to ship oil from Saudi Arabia to Louisiana. Well, they can rent a ship, and let's say the trip takes 25 days. So they rent the ship for 25 days, and they pay whatever the going rate is at that time. Frontline had their total fleet of ships on these per voyage contracts, which meant that if oil prices would increase, Frontline would start making a ton of money. Of course, with every investment, you've got to look at the risks as well. So Mohnish wanted to get an idea of what the debt on their balance sheet looked like. They did have a bunch of debt, but the debt was tied to each individual ship, so it was what is called a non-recourse loan. That's a fancy term that really means that if Frontline stopped paying the loans for the ships, the lender that loaned the money to Frontline could repossess the ship. But the lender couldn't go after Frontline to recover any additional money. That type of loan was a lot safer for Frontline because their lenders couldn't go after the company itself. When Mohnish was looking at Frontline, shipping rates were less than $10,000 per day. At those prices, the shipping company was losing money. When rates collapse like that, there's this interesting thing that happens in the market. So in oil shipping, there's two types of ships: single hull ships and double hull ships. After the Exxon Valdez ship sank and caused a massive natural disaster, all new oil-carrying ships getting built needed to be double-hulled ships. Double-hulled ships are much safer from an environmental perspective. If a double-hulled ship crashes into a rock, it's probably going to stay intact, whereas a single-hull ship would probably leak oil into the ocean. Broadly speaking, of course. The ships before the Exxon Valdez disaster were single-hulled ships. Now, at the time that Mohnish was looking at this potential investment, single-hulled ships were still in use, and they were rented for cheaper than double-hulled ships. When rates collapsed to below $10,000 per day, there wasn't a big difference in price between single and double-hulled ships. That meant that people only really rented double-hulled ships and ignored single-hulled ships, because if they have to pay an extra $1,000 per day to get a double-hulled ship, that's not a big charge. So once the daily shipping rates collapsed, a lot of single-hull ship owners got scared. They started imagining that the shipping rates would stay at $10,000 for the next 5 years, which would bankrupt them. And so people who owned these rust bucket single-hulled ships went to the scrap yards and sold ships for the price of the scrap metal. That's an unintentional thing that was great for the environment because it meant that there would be way more safer double-hulled ships floating around. When these shipping rates were low, the total global fleet declined from around 400 ships to something like 360 or 350 ships. When oil prices went back up, you didn't have those extra 50 ships. So when oil prices increased, shipping prices increased really quickly, like going from $10,000 per day to $200,000 per day in a span of 3 weeks or something like that. Because you literally couldn't find a ship to ship your oil. Before prices went up, Mohnish looked at the Frontline stock, and the stock was selling for $4 or $5 per share. And the liquidation value of all the ships was around $8 to $9 per share. This was in the early 2000s, by the way. So he figured that there would be a very small chance of him losing money because if the situation got terrible for the company. Frontline could always sell the ships for scrap metal. Looking at the scrap metal value, it was higher than the value of the company. So when he bought the stock, he was essentially getting the company for free. Before we dive into how this investment played out for Mohnish Pabrai, I'll quickly mention that if you're enjoying the podcast, please give us a rating and hit the subscribe button. And if you know someone who would find this content valuable, please share this episode with them. My goal for the podcast is to help people learn the lessons from the best investors and to help people understand the stock market better. I think that's important today as there's a lot of information out there that can lead people on the wrong path, and I would love to have more people benefit from this type of content. Alright, back to Mohnish. So he bought the stock, and in a few months, the stock went up to $10 or $11, and it kept going up after that. Mohnish was very happy with that, so he started to sell off his position, and then he moved on. He had something like a 55% return on this investment idea. Then, a year or two later, the stock was worth over $150 per share, and Mohnish missed that entire run-up. The stock went from pure pessimism to pure euphoria. Looking back, Mohnish mentions that when you see an extreme compression in share price, there's often an overshoot on the other side. So one of his takeaways was that he could have left a small position in the company, and that would have made him a great return. So let's go over some of the lessons from his story. The first is the importance of a circle of competence. This is key. Mohnish talks about how he doesn't understand 90+% of stocks out there, but he said that he doesn't need to understand all stocks. He only wants to invest in companies where he deeply understands or can learn about the business. If you understand the business, it's going to give you an edge when deciding to invest or not invest in a company. If you don't understand the business, on the spectrum from investing to speculating, you're probably leaning more toward a speculation type of a situation. Knowing about single and double-hulled ships, as well as the lead time to get new ships built, and that the supply of ships decreases during times when shipping rates are low, are all things that we covered in the story that are hard to know for someone who doesn't have a depth of knowledge in this industry. All of these points are obvious to someone who has a circle of competence in crude oil shipping. But these points might not be so obvious to a person that doesn't have that circle of competence. So there's obvious advantages to being an expert and to having your circle of competence and to staying within it. The other thing that the story illustrates is how in investing, knowledge is cumulative. You learn one concept in an industry and you can apply that to another industry to quickly understand the business dynamics that matter. Mohnish used knowledge of how commercial real estate had booms and busts and applied that model for oil shipping. That's the great thing about investing, is that a concept you learn in one area can help you understand a totally different industry. That's why investors who have been doing this for 15 or 20 years are able to sort through potential opportunities very quickly. They can spot patterns based on previous investments. I think that's why reading is so important for any investor. The more you read, the more you learn about how the world works. And you can then apply that knowledge to different situations to quickly understand if they present good opportunities or if they should be passed on. Alright, Vision Nation, that wraps it up for this week's episode. If you've enjoyed it, please hit the subscribe button, leave a review, and if you know someone who's interested in investing, please share this episode with them. Thank you so much, and I hope you have a great day. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. I may maintain positions in the securities discussed on this podcast.